you recording?
Yeah. If you want, you can just come here. You can have a tea.
I don't really like it. Sorry.
Oh, okay. Fine. Okay. Basically, what I'll be talking is about how to prudently go about investing in the stock market. So I've classified into all these 5 different topics like asset allocation, risk reward relationship, diversification, and leverage, fundamental technicalism, and I'll be identifying some key technical trends. So if you have any doubts regarding the terms, you can just
Risk and reward relationship?
Yeah.
No, I know that. Asset allocation?
Asset allocation is basically you have say suppose 100 rupees. Now how are you going to allocate this 100 rupees? In what instruments you want to put? Whether you want to put it in the equities, debt, or how to gold? In the derivative. So how are you going to put your money? How are you going to put it to work? So that is asset allocation. So this is a graph which shows the returns in equity investments. Okay, this is basically the returns over 7, 10 and 12 year period. So what you can see in this chart is that if you stay invested for a longer period, the returns will be higher. So say suppose this 7-year period is the blue chart here. See, this is kind of, it gives 25% in 1 year, but it again sometimes it falls below 6-7% in a year. But if you see this 12-year bar, you can see that the returns are almost more consistent, like more than 11 or 12%, it beats the inflation. So what you want your investment is to beat inflation. Suppose inflation itself is like 10%. Your real return should be more than 10%. So that is what you call as real return. It should beat your inflation and give you more than what the inflation is.
So if you have a 10% return, and inflation is 10%, if not, you've made zero return. Zero return, zero loss.
Exactly. So and this is actually what I'm trying to show here is like what is the FIAs and DIAs, what they do in the stock market, and how it affects the movement of the index. Okay, in India, what we are retail participation is very less. Mostly our stock markets are driven, or it goes up or down based on the foreign money coming in and out of the country. So what happened in 2008 is like you can see like the FIS pulled out.
The credit crisis.
Yeah, the credit crisis happened in 2008 and the FIS pulled out money. So the stock market crashed by over 50%. See, from 21,000 it came down to 50%, it just crashed. So what happened is that in 2009 and 10 they started pouring in money.
For no reason?
No, not for no reason. The valuations were very cheap at that point in time. So in 2008, as you can see, FIAs are bought, DIAs are bought, but DIAs are basically domestic institutional investors.
Okay.
Like our mutual funds and
within our country.
Within our country, yeah. So they bought in 2008, but it really didn't have an impact in the stock market. So you can see somewhat of a in 2009 they bought, but you can see in 2009 the DIAs also bought. You had a big rally. From the bottom, from May 2009 to December 2010, you had a big rally in the stock markets. The Sensex almost regained all its losses and it touched the 21,000 levels during December 2009. Yeah. So at that point in time, you can see the FIs and DAs have been net purchasers at that time. So again in 2015, you can see 2014-15 FIs have bought in and DAs are also pumped in money. So again, you had a stock market rally in the past 1 year, which was like
stock market.
We had a rally in the last 1 year.
Rally?
Rally is like momentum,
Okay, uptrend.
Yeah, uptrend. Okay. We had a up rally in the last 1 year, which actually during that time the FIs and DAs had bought in 2015. So basically, after 2010-11, what happened was we again had a crisis where India was not growing. We had a lot of policy paralysis, they used to say. Like there were the
strict policies.
Not exactly. The government was not able to push reforms.
Okay.
So there was a policy paralysis. They were not able to bring in reforms. During that point in time, what happened is that the FIs will lose interest. Okay, in the market. Suppose the reforms are not happening, infrastructure growth is not happening. the government is not able to push up, like pour in money into the private companies or push infrastructure, growth will actually slow down. During that point in time, the world economy was also not growing. It was a sluggish period. So at that point in time, what happened is that FIs in 2010, they kind of 2011 they pulled out the money. So again we had a crash in 2011. 10-11 we had a crash.
But we were pumping money, but they weren't.
They weren't, exactly. So what it says is that even though the FIs were, DAs or purchases during 2008 and 11, we had a stock market which went down.
Okay.
So this shows that FII investment has more impact on the market than the DAs. So even in 2015, if you see, DAs have pumped in a lot of money, but even though the stock market and some, like for the past 6 months, have not moved much. From 9,000 levels, it's been hovering around 9,000, 8,500. So there hasn't been much of
the
Nifty. Nifty Sensex or the benchmark index. So this is basically to get an idea of what the FIs and DAs are, how they are participating. It has an impact on our markets, so this should be noted. Next is asset allocation. Like what I'm trying to, you have to know what is your risk tolerance and what is the time frame. What period you are going to stay in the market, and what is the kind of risk you are willing to take. So period, when I say period, usually stock market investment should be staggered. Your investment should be staggered over a period of time. It should not be like one time you put in your money and you just go to sleep, or you just take it out after 10, 15 years. It should be over a period of time. What I call is you have to ride the cycle. You have to go through the ups and you have to go through the downs. As well as that's when you actually make money. In this sense, when you go through the cycle and you keep investing over a period of time. So, and then risk tolerance is how much you're willing to lose. Say, for example, when people had invested in 2008 January, after January 21st was the crash happened. So when people had invested at that point in time, they would have lost a lot of money by the end of 2009 May. They would have lost almost like 70-80% of the capital that you wiped out. But that was a very good period to actually bring in more money. But what people buying cheap. But what people do is that they're very short-sighted. They think that, oh my God, this is going to go down further. There'll be panic, which will settle. That's when they start pulling out money, but that would be actually the right time to actually put in more money. So that's what I say. But after 2009, the cycle started turning back again. So 2010 was a very good period. 2011 again the period started. It was a sluggish period. So you have to ride the cycle. You have to at least go through a cycle of ups and downs, say 5 to 10 year periods. So that's when you how you actually make money in the stock market. Somebody who famous person used to say that you have to buy in when there's a lot of pessimism and sell when there's a lot of euphoria. So when you say in 2008 there was a lot of euphoria, there was a lot of cheap money available, and people were buying all kind of absurd valuations. Valuations were, about valuations, right?
Yeah.
So valuations were sky high, and people are putting money. Recently, it happened in China also. The Chinese market have been. Are you following the world market?
No, isn't China growing at a very fast rate?
No, China was growing at a very fast rate.
Now it's we've overtaken them.
Yeah, that's because the stock market has rallied 150% last before this crash happened.
In 1 year?
In 1 year it had rallied so much. And valuations are just 200 times, 300 times it was trading on many of the stocks. So it's been like chaos happening in the Chinese market. Right? It's been up, down 8%. In a single day it just moves up 8% down and down. So that's what happens when there's a lot of people who don't know anything about stocks, who don't know anything about investment, just buys companies or takes a loan and buys a company, and the valuations just go crazy. So that is when you have to be a little cautious and you have to put out money. So you should know when to get in and when to get out, and when to actually stay invested. So these 2 points make a very important thing, like risk tolerance and time management. And see, I basically categorize my investment into 3 different groups. Okay. One is ETFs, second is defensive stocks, and third is a beta stock. Now, what I call have you heard of exchange traded funds?
I've heard of it numerous times, but I don't really understand it.
Okay, exchange traded funds are very, very popular in the United States. Mostly like 60% of their funds are exchange traded funds. Mostly people don't buy individual companies; they buy the index. So exchange traded fund is a basket of stocks which can be traded on a daily basis, whereby you can buy and sell. Okay, as a stock, you can buy an index.
A bunch of companies as one stock.
As one stock, exactly.
Isn't that the same as an index?
That's what you actually try to buy the index. You buy the index. So you buy Sensex or you buy the Nifty, you buy the top 100 companies, you buy the junior index. So all these good pedigree companies have been bunched together as an index. Okay, as a stock. That is called an exchange traded fund.
Okay.
So here what happens is that it's a mutual fund product. What happens is that you don't have the fund managers, it's not left to the fund manager's discretion as to choose the companies or which ones to buy or which ones to sell. The index is already formed, the weightage is already there, it's traded as a stock. Now what you get here is that the returns will actually mimic the index returns. So suppose your economy is growing at 10%, the index is also gone up 30%, your returns will also match the index.
Okay.
So that's a kind of investment. What I do is that majority of your investment should be in ETFs. So it is for risk averse traders. People who don't know about companies, who cannot track their fundamental, don't know technicals, don't know anything about stocks.
Should buy ETFs.
Should buy an index.
But you said something. You said it's not left to the fund manager's discretion.
Yeah.
What does that mean?
It means
the
that
mutual fund is managing it, right?
Yeah,
so
it's a mutual fund product, but the allocation into the individual companies is decided by the composition of the index. The composition of the index is it's a benchmark, right? The Nifty is a benchmark. Some companies may move in and out of the Nifty based on certain parameters. So this composition won't change. So the fund manager has to compulsorily invest your money in that composition in that particular index.
Okay.
So that you cannot pick and choose this company over that company.
Okay. Alright.
You cannot choose one over the other. It's not left to his discretion.
It's not his personal views.
Yeah, views. Yeah, exactly.
Okay.
So that is what an ETF is. Next, I categorize the second set of companies as defensive stocks. Now, defensive stocks are basically stocks which are not affected by the economic cycle, like the interest rate cycle. Pharmaceutical to next year, but mostly FMCG companies. Fast moving companies.
FMCG companies.
Yeah.
Why are they impacted by the economy?
What happens is that FMCG companies have a constant demand. Okay. India is a growing economy.
Yeah.
We have a constant demand to buy soaps, oil, all those things. These companies, their demand actually doesn't go up just like that, or just overnight it doesn't go up. Or the government policies don't impact these companies much. Say for example, if the company is now going to come out, we are not going to invest more money in infrastructure, or the interest rate cycle is going to going up, we are going to raise the interest rates. All these things doesn't affect much these companies. These companies have a continuous people who are using their product demand.
Okay.
So what happens is that the cash flow is being generated on a consistent basis. So that gives us a cushion as to the valuations. The valuations might be pretty high. FMCG companies, typically their valuations might be high, and they will not move in such a rapid pace. Okay, they might be a little sluggish when the economy is growing. They might move very slowly, but when there is a downturn also, they will not fall as much as the other stocks. So it gives us a cushion. Excuse me. So the second thing is the defensive, and third is the beta stocks. Beta stocks are which move more or less than the broader market. See, what I term as beta is that suppose the Nifty moves say 10 points and your stock moves 20 points up or down. It means it has a higher beta. So the beta is slightly higher than the index. So that is what I call as beta stocks. So stocks which move higher or lower than the index.
Okay, it's based on the movement.
Movement, exactly. Okay. Movement in price.
Okay.
So I'll tell you an example what a beta stocks is. So why ETF? Say ETF is a basket of that stocks that reflects the composition of the index, like the CNX, Nifty, or the BSE Sensex. Okay. Now what it says is like that, according to Standard & Poor's, 63% of active large cap fund managers in US did not beat the S&P index in 2001. So they are not able to beat the index itself. If there is left to the discretion, so if somebody buys just an ETF, okay, and somebody goes and gives it to the fund manager, please manage my fund, and says, and he buys certain set of stocks. So most of them, majority of them are not able to beat the returns which the index is giving. So that's why.
What does that mean? They are buying the index, right? The ETF.
Yeah, that's what the returns which an ETF generates is more than the returns which a fund manager who manages an active fund, is what his return is less compared to what an ETF generates. Now, some of the ETFs which are listed in our exchanges are basically these 4 ETFs here. So this you can see here. This is called the most shares mid cap index. It's an M100. It's called M100.
Okay.
It's managed by Motilal Oswal. So actually, current valuation is around 14.4 right now. It's 14 rupees 40 paisa. So this is the return it has generated for the period. Say this is 1 week, 1 month. This is for 1 year. And this is for 3 years.
That's percentage.
Percentage, yeah. So it's like you can see like it's almost like 46.8% return is generated over the 1 year period. And yeah.
Are these recent figures?
We are very recent figures. Actually, it's concluded week. Yeah. This one is called the Goldman Sachs Bank Nifty.
Goldman Sachs.
Goldman Sachs. So bank, we have a separate ETFs for banks. So the money which you put in will be invested in the bank Nifty. That is a composition of banks, public sector as well as private sector. The top banks, HDFC, ICICI, all these banks. So, and this is the.
They'll pick the.
No, the index is already there.
Okay.
The exchange has already given the index. What are the stocks there? So this is just an instrument which is by means where you can invest in this index.
Okay.
So third is a junior.
So as a private investor, you can't invest in indexes.
No, you can. That's what I'm trying to say. You can invest in an index. It's a share actually. It's quoted in the exchange. You can buy in and sell in, and you can do intraday trades also on this.
Okay.
Yeah.
But then why buy an ETF? Because it's not left to your analysis. Because you don't have to analyze it yourself.
You don't have to analyze it, but what happens is that sometimes the ETF might also suppose that there's a big rally in the markets, and you bought an ETF before, and it is giving you say 10-20% in just a week's time. Well, you can sell it, right?
Yeah.
You can sell it and probably wait for it to come down. So you can buy it again. So you can buy and sell an ETF also. That's what I'm trying to say.
Okay.
Like a stock. So suppose you say the stock is overvalued. So what do? So you sell it.
So these are stocks.
These are stocks, yeah.
These are listed stocks.
Listed stocks, yeah.
Okay.
You have the mid cap, you have the bank Nifty, you have the junior. This is the Nifty Bs. Nifty Bs are typically the Nifty levels. Nifty companies.
Okay.
Which invest in Nifty companies. So if you see the returns are somewhat less when you compare the other three, because these have slightly higher beta in the sense that
Goldman Sachs Junior.
Yeah.
What is Junior for?
Junior is basically the mid-tier companies which come second run companies. So what I suggest is that you allocate your portfolio between these three different categories. You have the ETFs, you have the defensive stocks, and you have the peer stocks. Okay, and so basically what a fundamental analyst does is like he includes macro. Macro in the sense is economics, right? Macro is
on the whole scale.
On the whole scale.
On the
Important. What is the economic cycle we are in? Whether we are in the growth stage, whether we are in a kind of stage whereby we are not growing much. So economic cycle we are in is very important. Technical analysis involves reading charts and trends, as you know. So as I say, technical analysis tool is more used by short-term traders. Stock movements are based on fundamental news. What happens is that suppose you read in the papers and you say the company has gotten orders, or the company is probably looking up, or something or the other happens to particular
it's based on events.
So what they do is the stock price suddenly goes up, say 5-10%. But you shouldn't create news to justify the price action. Okay, that's what I'm trying.
That's illegal, I think.
No,
people do that in penny stocks. They pump it up.
What I mean is like stock price movements are based on fundamental news. Do not create news to justify price. Say suppose the stock might have gone up 5% for various reasons. Somebody big investor might have sold into, or somebody might have an idea of like say in the next 5 years I'm bullish about this company. They would invest in it. So what typically happens in the Indian market is this. People want news, people want something to know why the stock is going up. Okay. So they create news to say because of this is going up. Because somebody in China, said something, the stock market is going up. Because Modi is coming to, this part, the stock market is going up. So they create news to justify the price movement. That is actually wrong in the stock market. Okay. So you just cannot you can hear something and okay, fine, I've heard this news.
But it moves anyway, right? The stocks.
Yeah, it moves anyway.
But it goes back to its value.
Yeah, value, exactly.
Yeah.
So you get it. So that's what happens typically. Or you get news, somebody says something, so people just start, okay, fine, this is going to go up in the next 10 days. Let's put in more money into this. Typically the investor does it, okay, and they end up losers because actually that might not be the case. So the stock actually corrects the next day or the
corrects, yeah.
So and it falls back. So do not create news to justify your price movements. So. And this is very important point. Forward earnings and management commentary important to catch the value. Like you have to listen to what the management is saying. Corporate governance and management plays a very big role in these programs.
You should read that report, the annual report. Right?
Yeah, annual report. And usually they come out when the earnings is there. Usually the top honchos they come out with the the
quarterly earnings.
The quarterly earnings. They come out with say the company's going to do well. They got orders and the future is kind of looking up. So these commentaries, the kind of tone they project about their company is very important to gauge whether the stock price has some more leg up. So then do not mix technical tools with fundamental news to justify your action. Again, you see some technical trends and you hear some news and don't mix these two together. So okay. Now it is diversification weightage. So as I said, you have to diversify your portfolio. You cannot put all eggs in one basket. And they say this, I heard a news about this penny stock. The stock is just trading 2 rupees, it's going to go up to 15 rupees in the next 1 month. So I'll put in all my money in this one stock. Suppose what happens if just the news is false news, or you'll be a big loser, your own capital will be wiped off. So what I suggest is that you have to diversify your portfolio and play the market upturn and downturn. So identifying sectors is very important, and asset allocation, like all stocks and asset classes don't move the same direction. Okay. So what happens is that during an inflation cycle, or if there is something for example, if there's a rate cycle, what are the stocks which affects during a rate cycle? Which are affected during an interest rate cycle. See, now RBI is coming up with this policy, right? Quarterly policy, RBI comes up with this monetary policy. Okay. So these policies are very important for companies which actually take decisions based on them. Say banks, for example, they will deposit rate, the lending rate is based on the RBI policy.
Okay, and infrastructure.
Infrastructure, because they tend to get a lot of loans from banks for their projects. Infrastructure projects are very huge projects, so they need funding. So the interest rates are at a very low levels. They will be able to get in,
they'll be able to grow.
Yeah, they'll be able to grow basically. So infra manufacturing, for example, manufacturing as well, are much dependent upon the government for their boost to give incentives like tax breaks and all.
Tax manufacturing.
Yeah, manufacturing sector. And then you have this rupee movement, currency fluctuation. So how it affects these companies? IT sector, you have these companies sometimes take huge foreign debts. They take debt from overseas borrowings they do. So all these companies which are overseas borrowings.
IT?
Yeah, IT companies.
They take investments.
No, they hedge for their currency movement. So they get revenues from abroad, right? So what happens if the currency moves, in a big way? So their revenues will get affected. Okay. So they hedge their risk. So all these rupee movement will affect for companies which take foreign debt. Some companies, go abroad and they take foreign currency loans.
attempt, yeah.
It's called FCBs, foreign currency borrowings. So they take a, if they take that, the rupee movement will affect their kind of, they have an impact on their earnings.
Okay, how, in what way does it impact?
No, what happens is, say for example, you have Glenmark Pharmaceuticals or JP Associates, companies which are like have huge debt in their balance sheet, okay, but they are not able to generate revenue. What happens is we have to repay this debt, right? Yeah. Suppose the rupee is right now at 50 rupees and it goes to 60. See, the kind of borrowings they take, a small movement in the rupee will also affect the kind of cash flows they have to, to match the kind of movement in the rupee.
Yeah, okay, I know that, but I'm asking how does it affect when you
the share price?
No, not the share price. How like if the rupee strengthens,
yeah,
they have debt, will they be at an advantage or a disadvantage?
That's what they kind of hedge it. See, some people hedge for the risk of the rupee movement. Some people don't hedge at all. Some companies don't hedge. They just let it, whether they have to, whether they have huge debt or not, they don't hedge their risk. So sometimes it affects their cash flow. It affects how much they're going to earn. Suppose for a Glenmark, for example, I have a lot of FCB payments to be made. Say, suppose the rupee is going to go up from say 60 rupees, it's going to go up to 63, 65, 70